The healthy April jobs number may mean a sigh of relief following the weak March numbers. Here to help us dig through the numbers is Mark Grimaldi of Grimaldi Economics and author of The Money Compass. Mark, welcome back to Arise Exchange. Thank you. Good to see you.
Happy to be here.
Okay, they call this the Goldilocks report. Why?
Because like you said in the open, it wasn't too hot, it wasn't too cold. And the stock market did rally on that, but there's some reasons it did rally. And some of those reasons aren't good news.
Absolutely. First, wages did not really go up much.
Wages over the last 12 months have increased 2.2%, which we all know is not even keeping pace with inflation.
And the reason that's key is, one, the Fed has targeted wages as one of the reasons it would raise interest rates, but also higher wages cut into corporate earnings.
Correct. So we have wages not growing, only 2.2, and we have low interest rates, and we have oil cut in half almost the last 4 months, and we still have a GDP that was almost flat in the first quarter.
And not to pour too much cold water on the hot jobs report, but also the labor participation number, which is people looking for jobs, continues to fall.
Correct. In 2009, I wrote and I forecast that the recovery would be extremely tepid. Here's what concerns me going to the next 3 to 6 months. Everything the Fed does, they almost always create a bubble. Housing bubble, stock market bubble.
They've created a huge asset bubble. No one's going to deny that.
They've created a huge asset bubble, and I don't think they're going to stop until that bubble is fully inflated.
And then how are they going to let the air out slowly? Because we had a picture of Janet Yellen deflating a tire because they would like to deflate it slowly, but they run the risk of popping the balloon if you believe this is a bubble.
They have no control in deflating it. They think they do, but they don't. And the reason there's so much talk about are they going to increase rates for the first time since 2008? What you don't hear the media telling you is they're concerned that if they increase it even the slightest amount, and then the economy softens, and then they don't continue to increase it, it's going to send a message to Wall Street that we're in a mess.
Well, and that's why many are saying you're not looking at anything until September at the earliest when it comes to interest rate hikes.
I happen to be in that camp.
Are you in the camp, which is sort of the extremist camp, that the Fed not only will not raise interest rates, but they're going to have to revisit quantitative easing?
I would be very surprised if they raised them in 2015. And again, that's not the popular opinion. Revisiting quantitative easing is definitely a possibility. When on May 29th, we're going to get...
What kind of message is that going to send?
It's going to send the correct message that the economy is not growing.
Right.
Eventually, like Ronald Reagan said, don't be afraid to see what you see.
Okay, but we are seeing more jobs created in the economy. What is creating those jobs? What is helping to drive that?
What's helping to drive that, very simple, is consumer demand. Believe it or not, consumers are the only part, but we're the only part spending. And we represent 2/3 of the economy, which is good, but businesses stop spending completely. Businesses aren't spending. We're spending.
Also, I wonder, when you look at the GDP, and we had a very tepid GDP growth, which may turn negative, but because of a trade imbalance, so it's not entirely based on the U.S. economy and how it's performing. That is sort of a leading indicator when it comes to job growth, isn't it, over the next quarter?
Absolutely. And it's going to be adjusted, as you mentioned, it's going to be adjusted on May 29th. A lot of economists, including myself, think it's going to be adjusted negative. Now, the good news is last year the first quarter was negative. So a negative first quarter this year may not be the worst thing, but it is technically halfway to a recession.
But can we get to 3% growth GDP this year?
Be very difficult. Not without job growth and not without consumer demand-driven inflation, and we haven't seen it.
All right, Mark. Well, we started the show very happy about the jobs report, and then you came in. But you tell it like it is. Thank you.
Thank you.
Mark Grimaldi.
Great to see you.
Appreciate it. Talk to you soon.